folks, Scott here, and this is the wrap for Tuesday, July 2nd. So let me show you what these are the 5-minute charts of the Russell, S&P, NASDAQ, and Dow futures. Let me show you on the cash indices. 7 consecutive dojis is just crazy. Crazy may be the wrong word. It's been sort of boring price action. It's been interesting price action. Just hadn't really made any progress after the open, though it's tried every single day. We've had 7 dojis. It's extraordinarily rare. It doesn't even show up when I look over the past 10 years of data. So nothing I can really comment on there going into tomorrow. But what I can comment on in preparation for tomorrow's gap is the fact it's the 3rd. And the 1st of the month is often a very unique day, as we talked about yesterday. The 5th of the month is also an unusual day for reasons I won't go into here. But the 2nd through the 4th are typically a very bullish period. So I thought it would be helpful to show the results of fading gaps between the 2nd and 4th calendar day of a month when above the 200-day moving average. So we use Gap Trader and back testing tool. And there you go. 2 things stand out. There's a 2-to-1 odds on the 2nd through the 4th of a month of gapping up, which would create a short gap fade opportunity, versus gapping down, and using our correction, an end of the day stop. And this is important because tomorrow is a shortened trading day, using a 1 p.m. Eastern time stop, right? Because we're not going to have all day for these markets to fill. So I thought it was worth showing the results. So this is using end of the day stop, which is 1 p.m. and fading all gaps on the 2nd through the 4th above the 200-day moving average. So the second thing that stands out is that both of these have lower than average win rates, right? This is, you'd normally expect about a 70% win rate, and the 1 p.m. time stop certainly hurts some. I don't know if it hurts a full 10 percentage points. But bottom line is, this is at least one study that in my mind shows a little bit of potential risk for fading a gap in either direction tomorrow. Now, I will rerun these numbers for members of the morning using our MTG stop parameters, which is simply just a volatility adjusted stop equal to 30% of the 5-day ATR, to confirm how attractive or unattractive these setups are. But there's a little food for thought going into tomorrow. Apologies, you can probably tell if I sound like Barry White. I'm not. I've just got allergies kicking right now, so a little bit tough. I'm going to keep this on the short side. Tough for me to do and tough for you to listen, I'm sure. Let me show the worksheet. We had nominal gaps in opening right around the close. So even a gap up wasn't overly attractive, nor a gap down too bad either, unless we'd happen to gap down and open below the lows, which looked like was a chance this morning as we sold off into the open. But we had up with nominal gaps, so I wasn't going to trade them. The patterns, you can look at these at your own leisure. Go ahead and pause the video, read the definitions there. Bottom line is, in my mind, there was a slight preference or bias for shorting up gaps, but down gaps look to be neutral to risky. In fact, that's what I posted about 9:15 Eastern time this morning. Added a couple more patterns from last night that showed some risk for down gap. You know, this current market condition, 50 above the 10, above the 200. Another interesting one, fading gaps after a 5-day high close that was not a 10-day high close, and less than the 50 above the 200. So very specific. What it shows you is down gaps are definitely much riskier. So you've had a little bit of strength, but not too much, and you're below the 50-day moving average and overall bull market. Down gaps actually are more prone to profit taking, is the way I interpret that. A little bit of risk. So bottom line, neutral to mixed guides. Basically mixed data, though slightly positive for up gaps. No clear edge equals no gap trade for me. And we opened dead flat in the ES and ran straight up, almost touching the highs, then rolled straight over. In fact, that same nuance that kept me out of trouble yesterday, my rule that I don't go long around noon time frame because you're prone to false breakouts. Sure enough, triggered again is the low volume and sucked some people in, and they got slammed. I didn't do anything all day. The 15-minute and first hour range guys just did not show a clear edge, so I wasn't feeling well. Volume was going to be dry going into the holiday, or lighter. Better ways to use my time doing research, so that's what I did. And absolutely no trades. After a very busy yesterday, I did no trades today. So we'll see if we get an opportunity in the morning. But otherwise, that is the wrap for Tuesday, July 2nd. Have a good night.